Good morning and good afternoon, everyone. This is Audrey Sunner, and I'm the Sales Director of CLTC. I want to thank you for attending today's webinar, which we will take a look at how to fund long-term care with a reverse mortgage. All of you will be in listen-only mode for the duration of the presentation. If you have any questions, please type them in the question and answer section, preference over the chat. In your webinar control panel, and I will pose them to the speaker at the end of the presentation with any time remaining. This webinar is being recorded and will be available on the CLTC graduate site along with the PowerPoint by the end of the week. And you can watch for an e-alert announcing the availability. Now I'm pleased to introduce to you today's speaker, Stephen Sless. Stephen is the president of the Stephen J. Sless Group of primary residential mortgages. We also have Christina Harmes. He will introduce you to her in a bit later. Stephen has nearly 20 years of mortgage industry experience, including 13 years devoted to reverse mortgages. He is also one of the few mortgage professionals to have earned the CLTC designation, demonstrating that he has acquired the critical tools necessary to discuss the subject. His group has established a reputation for bringing a deeper level of knowledge of how housing wealth fits into a winning retirement income strategy. By 2021, PRMI's reverse mortgage volume had risen 400%, prompting Stephen's promotion to Reverse Mortgage Division President. A frequent conference keynote speaker for NRMLA, the national voice of the reverse mortgage industry. He also gives seminars and learning workshops for homeowners 60 plus. Committed to giving back, Stephen serves on the board of Pikesville Owings Mills Regional Chamber of Commerce and does service with the Alzheimer's Association of Greater Maryland. Stephen also loves spending time with his wife and his 2 young daughters. Stephen, thank you so much. We are tickled to have you, and we look forward to your presentation.
Audrey, thank you. Great to be here. Thank you so much for having me. This is going to be fun. We ready to get started? All right, let's do it.
We're ready.
Let's do it. So again, great to be here. Thank you so much. With me today is Christina Harmes-Hika. You'll be hearing more from her as the presentation goes on. Christina is an absolute rock star in the reverse mortgage industry, one of the most recognizable names and successful leaders in the reverse mortgage space. We're thrilled to have Christina running our West Coast region for the Sless group of PRMI, and you'll be hearing from her real soon. With that all said, let's dive right in. And let's talk about why we are here today. First, let's talk about why you are here today, or why I think you're here today. You're here today in all likelihood because there's less than 3% of baby boomers that actually buy long-term care insurance. Yet 70% of baby boomers will need some sort of long-term or extended care during their lifetime. Now, why are we here? We're here because there is $8.05 trillion, trillion with a T, $1 trillion in untapped senior equity nationwide. $8.5 trillion. Remember that. That is going to be key as we go through this presentation. Remember that $8.05 trillion in untapped equity, yet only 2% reverse mortgage market penetration. So what does that mean? Only 2% of those who would be eligible for a reverse mortgage actually take out a reverse mortgage. This is the time for our industries to align, right? There's less than 3% of baby boomers that are buying long-term care insurance products, even though these are incredible products. 70% of them will need this care. Only 2% of those who are eligible for a reverse mortgage actually take one. Our industries are so alike. There's so many myths, there's so many misconceptions, and there's the need to educate. But we're a lot stronger together than we are apart. Moving on. let's get into today's agenda, what we're going to cover today. The first thing we're going to cover today are just the basics, the ins and outs of reverse mortgages, particularly for those who this may be your first time attending a reverse mortgage webinar or seminar. We're going to go over just the basics. We're also going to talk about options for leveraging housing wealth to fund long-term care insurance, funding the actual insurance policy with a reverse mortgage. We're going to talk about options for self-funding care for those who don't qualify for long-term care insurance, particularly now in this hopefully post-COVID world that we're all going to be living in soon. How many people have had COVID that are of age to obtain a long-term care insurance policy that now won't qualify because of the COVID pre-existing condition? Who knows what this long-term care insurance market, how they're going to look at COVID, so on and so forth. There are a lot of people who won't qualify, whether it's because of COVID or not, that need to fund their care. We're going to provide a great way for them to do that today. We're also going to talk about reverse mortgage strategies for funding long-term and extended care, just different ways reverse mortgages can be tailored and structured. We're going to go through some case studies, and then finally, we're going to close it out today with some Q&A. I want to point out to you, today is not a one-time offering, right? We are here for the foreseeable future to help you, to guide you, to interact with you and your clients to make sure that you are able to provide the reverse mortgage as a tool, as a funding mechanism to fund care. So what we're going to go over today, hopefully you take a lot away from it, but we are here for you every step of the way. During this presentation as well, towards the end, we're going to be sharing our contact information and the best ways to reach us. But please don't hesitate to reach out. We are here for you and to help you guide your clients towards a better retirement and better long-term care. You may have been invited here today by a PRMI loan officer. If you were, fantastic. Thank you to all my PRMI colleagues for inviting their strategic partners here. If you were invited by a loan officer, keep their contact information. They are going to be your point of contact. If, however, you weren't invited by a PRMI loan officer, at the end of this presentation, we're going to be sharing our contact information. I encourage you to reach out to us, and we will set you up with a loan officer in your area, or Christina and I can work with you directly. We will match you up with the perfect reverse mortgage specialist to serve your clients. PRMI has a dedicated reverse mortgage email. It is reverse@primres.com. That is the best way to reach us post this presentation today, and if you want to be put in touch with a licensed specialist. So let's talk about who we are, and we'll cover this briefly. A lot of you on here today know me. I've interacted with a lot of you. We have some of our best and favorite strategic partners on here today. I'm the president of the reverse mortgage division here at PRMI. I have about 20 years of mortgage industry experience, 13 of which dedicated and devoted to reverse mortgages. And I've been a CLTC graduate since 2019. Thank you, Bill Comfort. And on that top, real quick, before we get over to Christina, I do want to acknowledge a few people that are on here today. Bill Comfort being one of them. Bill was my instructor at the CLTC. I believe I took one of the last live classes offered back in December of 2019. So Bill, hope you're on, think you're on. Thank you so much for all you've done for me and my career and what you continue to do for the long-term care industry. Mike Banner, my buddy, Mike Banner. Folks, if you haven't watched the 62 Who Knew TV show on WeBeam TV, Mondays at 5 p.m., checks in the mail, hopefully, Mike, you should do so. Mike is an incredible resource, and he is, in my eyes, the godfather of bringing the long-term care and reverse mortgage industries together. Noel Evans, Kathy Zagorski, I can go on, and our PRMI colleagues. Thank you so much for being here today. Meet, please, Christina Harmes-Hika. Christina is one of only 170 certified reverse mortgage professionals nationwide. That is a reverse mortgage specific designation Only the best of the best have it, only 170 nationwide. We're grateful and lucky to have Christina as a part of the Sless group. She is our regional manager, running the West Coast region and growing out our West Coast presence. She's based out of San Diego. Christina has 19 years of experience in the reverse mortgage industry and 9 dedicated to the reverse mortgage space. She is a top reverse mortgage producer, and I referenced this at the beginning of the presentation, one of the most recognizable and successful leaders in our space. And you'll be hearing from Christina real soon. Let's go through some facts. We're going to run through this pretty quickly because I want to make sure we get to the Q&A at the end. So I'm gonna start flying through here. I will try to stop myself if I feel like I'm going too quickly. Again, here we go. There's 8.05, says 8.5. It's actually $8.05 trillion in untapped senior home equity. 10,000 people a day are turning 65, and this will continue until the year 2030. More than half the US population, and for you CLTC graduates and long-term care professionals, a lot of these stats you know, but there are people that are on here that aren't as familiar with these stats, so I'll run through them briefly. More than half the US population will need help with at least one activity of daily living in their lifetime. And in 2019, the monthly average cost for just unskilled home care was over $4,300 a month. If you need skilled nursing care, that number is going to be even greater. And by 2039, that's projected to rise to over $8,000 a month. So you can see the need. However, go back to the very first bullet point and the theme of this whole presentation. $8.05 trillion in home equity that is just sitting there dormant, unused, that can be leveraged and repurposed for our clients to live a better and more comfortable retirement. But isn't a reverse mortgage a last resort, right? I get this question all the time. So let's talk about for a moment what reverse mortgages used to be. And I'll try to cover this pretty quickly. So prior to 2015, if you were over 62 years of age, you had at that time 25 to 30% equity in your home, and you had a pulse. We could lend money to you by way of a reverse mortgage. It was easy money. There was no credit requirement. There was no income requirement. Literally, you're of age, you have equity, and you're alive, we could have lent you money on a reverse mortgage. And what happened was there was money lent to folks that it was a little bit too late, right? They were using the reverse mortgage as a loan of last resort. They were trying to put a Band-Aid on an open wound. The reverse mortgage was never designed to be a loan of last resort. When the loan was created in the 60s and FHA started insuring these loans in the mid 80s, they never designed these loans to be a loan of last resort, but because the credit terms were so easy, most folks were using it as such. And what happened was there was a lot of folks that failed to meet the 3 major requirements of a reverse mortgage. You have to pay your homeowner's insurance, you have to pay your property tax, you have to maintain the home, and of course, HOA fees or condo fees. But it was one of those or multiple of those that were defaulted on, causing folks to be foreclosed on. And so if you've heard on the news or if you've heard, I had a reverse mortgage, but I lost my home. It wasn't because they had a reverse mortgage. It was because they failed to meet the requirements of the loan. What about a traditional mortgage? What about if you have no mortgage at all? If you fail to pay your HOA, you fail to make your property tax payments, the municipalities or your HOA or your condo association, they're going to foreclose on you, right? And so that happened at such a high rate that the government stepped in and in 2015 implemented what's now called the financial assessment. That's reason for us now to pull credit. We have to do a full credit analysis. We have to do a full income analysis. We have to determine whether the person that we're lending money to is able to afford their taxes, is able to pay for their homeowner's insurance, is able to maintain their home. There's also been a lot of advanced research. Wade Fowl, Jamie Hopkins, Tom Hegna, just to name a few. Look up their research, look up their white papers. What they've discovered, and these are folks that are a lot smarter than me with a lot more letters next to their name than I have. I mean, when we're talking PhDs, doctors of retirement research, and what they've discovered through their research is that reverse mortgages should never be used as a loan of last resort. But when incorporated into a holistic, comprehensive retirement strategy, you're able to extend the longevity of the entire portfolio. And isn't that what this is all about? Right? The goal in retirement isn't to die with as much home equity as possible. It's to leave as much of a legacy as you can and to extend the longevity of your portfolio so you don't put yourself in danger to run out of money in retirement. It's their research. And I think as the years and as the decades go on, their research is going to transform the retirement livelihoods and the longevity of so many senior homeowners nationwide. There's also been several product advancements. There's no prepayment penalties. There never have been, but there used to be servicing fees. There's no more servicing fees. There's a lot more options. There's line of credit options. There's tax and insurance options where you can actually put money into an escrow account now. You can never do that before. There's been so many product advancements over the years. The combination of the financial assessment, the advanced research, how we utilize reverse mortgages today because of that research, and the product advancements really makes the reverse mortgage product one of the most, if not the most, secure, safest products on the market today. Let's go over some basics. So who's eligible for a reverse mortgage? Well, at least one homeowner needs to be at least 60 years or older, 60 years of age or older. You need to have roughly 50% equity. You must remain owner occupied. The home always has to be owner occupied. You can't do reverse mortgages on investment properties, anything like that. Vacation homes, you can't do reverse mortgages on those either. Various property types may qualify. And this is key, home values up to $10 million. There is a completely new market for reverse mortgages. It's a high net worth market. We're going to jump into this in a few minutes, but there's different jumbo and proprietary reverse mortgages on the market right now. We did a loan not too long ago in Boca Raton, Florida, a $5 million home free and clear. They took out a reverse mortgage. You know, you would never have thought 10 years ago that somebody with those type of means would be taking out a reverse mortgage, but today they are. And it's because of the research that was done by the gentleman that I mentioned and plenty of others. But we can actually lend on home values up to $10 million. It's pretty amazing. And we must account for all spouses. This is something that happened in the past too, and this was a stain on our industry where in order to max out the available dollars available, there would be people that removed their spouse from the title of the home, you know, so because we have to lend based on the age of the youngest borrower. Oftentimes, particularly in cases where one spouse was a lot younger than the other spouse, they would remove the younger spouse off of title, putting that spouse at risk to lose the home when the older spouse passed away. That can no longer happen. All spouses must be accounted for, and we're lending on the age of the youngest borrower. There's no term with a reverse mortgage, and there are flexible repayment options, right? Payments can be made anytime on a reverse mortgage or not at all. The big difference between a reverse mortgage and any other type of loan out there is the borrower is in control, right? They're in the driver's seat. They can make interest-only payments if they want to and keep their balance the same over time. They can pay the loan down, or like most, they don't have to make any payment at all, and they can defer payback until they leave the home. Borrowers may opt to make payments at any time. It's completely up to them. The loan becomes due and payable when a few things happen. The last remaining borrower or non-borrowing spouse leaves the home, they pass away, they sell the home, or they default on the obligations of the loan, property taxes, homeowners insurance, HOA or condo fees. So as long as they don't have to make monthly payments, but they do have to make sure that they meet the obligations of the loan. And then we're going to go over some options, some features, and some safeguards, and then we're going to get into why you're all here. What does this all mean for long-term care and long-term care insurance? Today's reverse mortgages interest rates are very low. Most government-insured reverse mortgages, which comprises 95% of the market, is going to they're going to see a rate in the very low threes as of today. Some of the jumbo and proprietary options, their rates can go anywhere between 4 to 7.5%. So we put on here 3 to 7.5%. There are lump sum options for distributions. There are monthly deposit options where a borrower can receive a check each and every month for as long as they live in the home. Line of credit options. The reverse mortgage line of credit, I want to touch on this briefly, is unlike any other line of credit on the market today in that it has a guaranteed growth feature. A guaranteed growth feature. Think of it like a credit card, right? If you have a $20,000 limit on your credit card, and each year we're going to tell you that you can borrow a little bit more. We're going to raise your limit a little bit incrementally each year. The growth feature is a 0.5% over the interest rate on the loan. So if the interest rate's 4%, you get 4.5% compounding growth on your line of credit. And we'll get into how to use that line of credit to fund care a little bit later on. And a reverse mortgage can be tailored to suit the needs of your clients. You can combine payout options. We can really take a deep dive into the goals, the wants, and the needs of your clients to help them tailor a reverse mortgage that's going to be the best fit for their retirement needs. I alluded to this before. There's also non-FHA and jumbo reverse mortgages. Those loans are unique in that there is no FHA mortgage insurance. There are lower closing cost options because there's no mortgage insurance on those loans. Condos are eligible. They do not have to be FHA approved. Loan amounts up to $4 million with home values up to $10 million. It's incredible, the jumbo reverse mortgage market today, where you literally have folks that are worth millions and millions of dollars living in homes up to $10 million that we can lend $4 million and they're able to defer payback until they leave the home. And think of, right, think of your long-term care clients. Think of their net worth, right? If they're able to afford the insurance and they're coming to you because they want to purchase a long-term care insurance policy, think about explaining to them these different options to do so and being able to fund the long-term care insurance policy without depleting their investment portfolio. These are incredible options for higher net worth borrowers. But of course, you always have the misconceptions about reverse mortgages. The first of which, and probably the most common, is the lender or the government somehow owns your home. And that is unequivocally not true, right? The borrower, just like any type of mortgage loan, owns the home, right? It's just a mortgage. There's a mortgage lien on title. There's a mortgage note. They own the home though. They're not passing on ownership to the lender or to the government. Another misconception is to qualify, the home must be free and clear. Not true at all. When we get into the options to fund care, you're going to learn that oftentimes a lot of folks are taking out reverse mortgages to pay off and replace their traditional mortgage loan with a reverse mortgage, freeing them up of that mandatory monthly payment obligation. But no, the home does not have to be free and clear, and oftentimes they aren't. And a couple more misconceptions. There will be nothing left for my heirs. I get this all the time, and I love addressing this, and I love getting into this with financial advisors. First of all, the heirs inherit the home just as they would with a traditional mortgage. They need to pay back the mortgage when the loan comes due, which is when the reverse mortgage borrower passes away. The home is passed to the heirs. The heirs will have a fixed period of time to determine how they want to settle out the reverse mortgage loan. They can pay it off through means of their own and keep the home, or they can sell the home through the proceeds of the sale, pay off the reverse mortgage loan, and any remaining equity is theirs to keep. But through the research of Wade Pfau and Jamie Hopkins and Todd Mahagna and a lot of others, what we've learned and what we implement in our practice every day is that when you incorporate the housing wealth, that $8.05 trillion in untapped housing wealth, when you incorporate that and you make it a part of the overall comprehensive strategy, you're extending the longevity of the overall portfolio. Meaning that the heirs, in a lot of cases, and we see this all the time, even though you may be passing on less home equity, what you are able to do with this reverse mortgage and the way that you are able to structure it and being able to protect and preserve your other investment portfolio means that the heirs, and oftentimes they get more, not less. By taking a reverse mortgage, you're actually able to pass on more, a bigger inheritance, versus not taking out a reverse mortgage, or even worse, using a reverse mortgage as a loan of last resort. And the last misconception is the home cannot be sold or refinanced. Absolutely not true. We are refinancing reverse mortgages every day. There's a big market for reverse mortgage refinances right now. You have a lot of folks that have higher rates. Home values have gone up. If they took their loan out prior to 2017, we can lower their mortgage insurance premium, or they can refinance out of a reverse mortgage into a more traditional type mortgage, or the home can be sold and the loan can be paid off. No different than any other type of mortgage. All right, here it is. What we came here for today. And before I'm going to pause here for a moment and take a sip. Here are these 6 most popular and best ways to fund long-term care with a reverse mortgage loan. The first of which is to pay off a traditional mortgage loan and to replace that traditional mortgage loan with a reverse mortgage, freeing up the cash flow to be able to fund a long-term care insurance policy if that's the best option for the borrower. We see this all the time, right? The client has a $1,000 payment, a $1,500 payment, a $2,000 payment. A reverse mortgage is eliminating the need to make that monthly payment, allowing the borrower to defer payback until they leave the home or until a later date, and they can repurpose that cash flow to perhaps fund a long-term care insurance policy. The second way is with a reverse mortgage line of credit or a buffer asset, because that's what it is. You're setting up a bucket of money, a pool of money outside of the investment portfolio for strategic use. So that line of credit is there. It's parked in reserve. It can be tapped into if and when those funds are needed, and they can be tapped into very strategically to either pay for a one-time policy premium or to be able to afford the monthly payments on a monthly policy premium. A 10-year payout is a guaranteed check sent to the borrower of the reverse mortgage every month as long as they live in the home. And so if you're talking to a client, a long-term care insurance client, you give them a quote, it's $800 a month. They don't know where they're going to get those proceeds from. They can tap into the equity in their home, leverage that home equity, turn on what's called a 10-year payment. Think of it as an income annuity coming from the home, and they're getting a regular monthly check to either supplement their income so they can afford the insurance policy or to just repurpose and fund that policy altogether. Now, I know what a lot of you are thinking. Steve, we can't use borrowed funds to fund a long-term care insurance policy. Why not? Why not? It can be done, right? We're doing it all the time. The key for our compliance officers to keep them happy and to cover yourself, right? The key is to do the right thing by the borrower every single time. Do the right thing by the client every single time. I am not here to tell you today a reverse mortgage is a solution to fund long-term care 100% of the time. Probably not even 80% of the time. Likely not even 60% of the time. But I guarantee you there are clients out there that are equity rich and cash poor. that can use the leverage, use the wealth in their home and leverage that wealth to fund a long-term care insurance policy if that's the best solution for them. But it absolutely can be done. We do it all the time. The key, especially for those who act as fiduciaries, true fiduciaries, is doing what makes the most sense, doing what is in the client's best interest all the time. And there are certainly circumstances where a reverse mortgage to fund long-term care is in the best interest of the client. Okay, that was a mouthful. You can do a lump sum payout, great for single pay premiums. Or you can combine payout options. You can combine a tenure, a line of credit. Maybe they need some money up front to do some retrofitting to the home. Maybe they need to do some renovating. They can combine payout options to be able to provide themselves with the best possible reverse mortgage to accomplish the goals that they would like to accomplish. But the most powerful way to fund a long-term care insurance policy with a reverse mortgage is with a reverse mortgage for purchase, actually buying the home with a reverse mortgage. And we have a case study coming up on that soon. And with all that said, I've talked a lot, probably talked your ear off a little bit. I am going to pass it over to the lovely Christina Harmes, and she's going to get into the very first case study.
Thank you,
Christina.
Steve. Thank you, Steve. I'm just going to dive right in. So this was an actual client a few years back, and it's Art. There's a fake picture. Of course, we changed the names for our case studies. But Art's son, John, he had found us because his dad needed 24/7 hour care. And Art wouldn't leave the home. It was his longtime home. The family really didn't want him to leave the home. But there were 4 adult siblings who were in their 60s themselves, and they were cobbling together every month to pay for this higher level of care. They were using their own retirement accounts. Or in some cases, some of them were still working and had kids in college. It was a tight squeeze. So John found us, and we went and met with Art, and I think there were 4 different people, family members sitting at this table. Art was still mentally capable. He was just very physically frail. He needed help walking. He needed help with almost everything, but his mind was still sharp. So he stayed with us with the reverse mortgage numbers. I loved it. Now, the cost of his care was $8,300 a month. That's almost $100,000 every year. And like I said, he was mentally good. So they expected him to stay alive for some time. Art had used up all of his own portfolio and only had Social Security. And he did have a small mortgage payment that he was still making. Well, his kids were still making for him. But he didn't have long-term care insurance. And John and his siblings had been using their retirement assets, as I said. It was just becoming unsustainable. So let's go over the numbers. Case study, pretty basic. He was here in San Diego. The home was valued at $700,000. He had a small mortgage of $85,000. The mortgage payment wasn't that small compared to his Social Security check, $752. And interestingly enough, the rate was 4.75 because he couldn't qualify to refinance it with his income. So he had a much higher rate than he really needed to at that point in time, but was kind of stuck in it. Hadn't given it too much thought. With the reverse mortgage, we were able to first pay off that mortgage, so free up that $752 a month, so bring that down immediately. Then we set up equal monthly payments of $7,800 a month to pay for that care. Now, those numbers don't perfectly meet, but with his Social Security and lowering that mortgage bill, well, eliminating it, he was able to make ends meet without his kids having to pitch in every single month. This is one of my, it's a little dreary, but you guys work with seniors as well. One of my absolute favorite stories, because this is the ideal. Art was able to live in his home for the rest of his life where he wanted to, on his own terms with help, and he actually passed away peacefully in his sleep. And that is the crown jewel of being able to help someone stay in their home, get the care they need. And the kids still inherited quite a bit. So this is where that misconception came in. They were able to pay for care for another 2 years for him, and they still inherited almost $450,000 between them. This case study was one of my absolute favorite clients. Art was just such a funny guy, and to be able to help him and his whole family in that way was just very eye-opening for me. Okay, so what's interesting, here's the actual amortization schedule. I know a lot of you guys are familiar with looking at these. So the two columns I want you to pay attention to is the cash payment. So in an annual amount, he actually received $93,000 to pay for that care from the home's equity, and the equity column. So when he actually did pass away 2 years later, the heirs inherited, actually it was San Diego, so they actually inherited more than that, but on our projections, we have to use just 4%. San Diego's appreciation in his area was closer to 5.5. So I believe they actually inherited quite a bit more than that. But for our projections, looking at what could be done, they were going to at least inherit 450. They ended up inheriting more than that. So it was a really win-win for that whole family.
It's an unbelievable story. It really is. And that is the stories that we come across every day. That is real life for us. We are transforming folks' retirement, transforming their lives, funding care. It's a very rewarding career path. And those of you that, help people plan for a comfortable retirement or are in the long-term care space, I'm sure can resonate with that. Here's another case study, and I'm going to go pretty quickly because I know we still want to get to some Q&A and we're a little up against time. The reverse mortgage for purchase, buying a house with a reverse mortgage. It's an unbelievable way to accomplish the goals of a lot of homeowners and perhaps to make sure that they have the funding to be able to afford care. So let's go through. These were clients of mine. We'll call them the Wellings. The age of the youngest spouse was 64. Their home value here in Maryland was $400,000. They owed $100,000. They had a $1,200 a month mortgage payment. That was just principal and interest. That was not escrow. So $1,200 a month, just principal and interest. However, their home was just not conducive to meet their long-term needs. They were on 3 floors. There was a lot of walking, a lot of stairs, and it just wasn't a home that they were going to be able to live comfortably in long-term and to be able to age in place. Their goal was to age comfortably in place. Fund care. They were very conscious of the need for care, and they did not want to be a burden on their loved ones. They were adamant that they needed to be the ones to cover their own care, and they wanted to preserve their retirement nest egg. So let's look at the numbers here, what they were able to do. The Wellings purchased a new home with a reverse mortgage. They bought a home on 1 floor. The purchase price was $300,000. They put down $150,000. Now they have free cash flow of $150,000. Remember, they sold their home for $400,000. They owed $100,000. So they net out, and these are averages. I know there's realtor commissions and that sort of thing. They net out roughly $300,000. They put down $150,000 to put themselves in the equity position to now qualify for a reverse mortgage. Remember, you need roughly 50% equity. They brought to the table the 50% equity. They bought their $300,000 home. They put down $150,000, leaving them with $150,000 of free cash flow. They also eliminated the mandatory $1,200 a month principal and interest payment and put that back in their pocket. They purchased, after this transaction was done, they're in their home, they purchased a single premium long-term care insurance policy, and they spent roughly $100,000 on that policy. And they supplemented their retirement portfolio with the additional $50,000. Let's look at the results here. The Wellings moved into their forever home. They funded the long-term care that was vitally important to them. They also supplemented the retirement nest egg. They increased their monthly cash flow by the $1,200 a month, and they have peace of mind for life. I mean, this to me, this is why we do what we do. They laid out their goals, and we were able to provide them with solutions to accomplish each and every one of those goals in a home that is more conducive for their lifestyle needs as they grow old and age in place. It's powerful stuff. And we have a third case study, and for that, I'm going to pass it back to Christina.
Really powerful. I love the downsize possibilities. Not everyone's up for downsizing. In this case, I had a client, Beatrice. She was 68 and she had been divorced, and her adult children lived in other states. So moving in with them or having them help with care was just not an option. She also didn't really want it, as we hear a lot. She was concerned about all of her care options because she watched one of her best friends use their entire portfolio to pay for her husband's care. Her husband ended up passing away and leaving that widow with almost nothing. So Beatrice was very shaken when she found me. She also didn't like the idea of a reverse mortgage. Once we got through the conversations, she had mentioned that she actually applied for long-term care insurance, but she medically couldn't qualify because of other conditions. She didn't need care now, but she really wanted to plan and make sure whatever she may need in the future, she was going to have available. That's where the reverse mortgage could come in. So by the numbers, her home value was $600,000. She didn't have a mortgage, so her cash flow was good, but she needed that cash. Her portfolio value was about $300,000, and she wanted to set up a line of credit that grew. After we talked about the reverse mortgage options, that was the most appealing to her. Check out the numbers, you'll see why. So the line of credit in the reverse mortgage actually grows over time, the untapped balance. And since she didn't want or need the money, she wanted to set it up early so that it could grow quite a bit over time. Now you want to look at that green line in the middle. The top line is the home's value, right? San Diego, we have great appreciation. So the home is appreciating. But that line of credit is also going up. And the longer she doesn't use it, the larger and larger it gets. If she never uses it, when she sells or the heirs inherit the home, it just turns back into home equity. But let's check out the numbers on the next screen. Just over 12 years, if she were 81 and finally needed some care, that line of credit had increased by $125,000. Now let's say she's happy, healthy, actually doesn't need care for much longer. Let's say she doesn't need care until age 91. Oh, Steve, can you do the next screen, please? Okay, so the LOC line of credit by age 91 has increased by over $275,000, which if you look at that figure on the screen, that means she has a line of credit to draw from of $570,000. That's quite a few years of care at today's rates. Of course, in the future, who knows what they'll be. I think you guys know better than I do actually what that will be. But that's a very large amount of money to be able to draw from while still staying in the home that she loved. This made her feel absolutely protected, especially after getting the devastating news that she couldn't qualify for long-term care insurance.
And this is tax-free money. I saw a question come up in the Q&A, and we're going to get to Q&A here in a moment, but all reverse mortgage proceeds, this is important to point out, are tax-free. This isn't income. This is their home equity that they already paid taxes on when they put it there, right? They put that equity there. They created that home equity. So it's all money that isn't being taxed. And that's another really strategic advantage when it comes to incorporating this housing wealth in the overall portfolio, using tax-free funds. And I'll point out this too, and before we move on, the home is a low growth potential asset, right? Most homes, we project 4% per year. Maybe it's a little bit higher in San Diego and on the West Coast, but think about what your clients' retirement portfolios have done over the course of the past few years. I would hope if you're an advisor worth your salt or working with one, I'd hope that's more than 4%. It could be 8%, it could be 10%, but using the home equity from that lower growth potential asset and accessing tax-free funds to then reallocate those funds and maybe buy a single premium policy, maybe free up cash flow for long-term care, maybe self-fund care. Maybe they're not interested in the insurance policy, but they still need to be able to fund their care. A reverse mortgage is an unbelievably powerful way to do that. All right, moving on. It looks like we're back on track. We did pretty well. If you enjoyed today's event, you will love our next event. We are presenting a seminar on June 16th for the IDFA, the Institute for Divorce Financial Analysts. PRMI is a partner of IDFA, so we're going to be doing a lot with them. We're also doing a lot more with CLTC. Our webinar on June 16th at 1 p.m. is how to use reverse mortgages to ease the financial difficulties of gray divorce. As you all, I'm sure, are aware, if you're not, we're making you aware, gray divorce is on the rise, right? Seniors going through divorce is on the rise. This is a huge problem. We can help solve that problem with reverse mortgages. An added bonus, if you're a CFP, we can offer you 1 CE credit for CFPs for signing up for this webinar. If you go to the IDFA website or email us at reverse@primeres.com, we can get you the link and get you the information to sign up for that continuing education credit. And with that, we are going to wrap up right on time, and we're going to open it up to some Q&A. Before we do that, here is our website and our main contact phone number. We are available. We are here to serve you, whether that's by linking you up with a licensed reverse mortgage expert in your state, or Christina and I working with you personally. We have a great team as well. We have a lot of just tremendous, talented reverse mortgage professionals here that would be happy to help. Contact us, reverse@primeres.com. Check out our website. Our website is very interactive. There's a lot of video content on there. I also would encourage you, please connect with us on LinkedIn. Both Christina and I put out a lot of content. Most of that content is LinkedIn and Facebook. She tends to spend more time on Facebook. I tend to spend more time on LinkedIn. And it just works really well for us. So connect with both of us on LinkedIn, friend us on Facebook, follow us on LinkedIn, the Stephen J. Sless group, and our YouTube channel. Can't forget the YouTube channel. We just wrapped up a really great video series where we covered every possible conceivable way to use a reverse mortgage to create a better retirement income strategy. The YouTube channel is the Stephen J. Sless Group. The Stephen J. Sless Group. While you're there, hit the subscribe button. And if you want to be notified, hit the bell. And every time we put out a new piece of content, you'll be notified. You'll be subscribed, interact, like the videos. We would love to engage with you on there as well. And with all that said, Audrey, I'm sure we have some really great questions. Do you want to kind of facilitate those to us?
I will, and they're rolling in. So we will be done at the top of the hour, but we will answer these. Stephen has basically agreed to that. He'll shut me off if that's not correct. And so if you need to jump off at the top of the hour, because the rest of this will just be Q&A. Your buddy Michael Banner says you're too kind. The next one is, I live in a 55 plus community. There are at least 20 other communities in my area. Do these types of communities permit reverse mortgages, and can they restrict reverse mortgages?
Christina, you want to take that one?
Sure. Yeah. So that's a great question. And the FHA type, if it's like a condo and it's a 55 plus, then we would need FHA approval, but we actually have another type of reverse mortgage that doesn't need that. So typically they're not going to be able to restrict if the actual homeowners own the homes. If it's 55 plus and they're renting, it's like a step up in care, then they're not owning the home, so they're not eligible. But I've actually done quite a few in 55 plus, and we can actually, you get a pretty good word of mouth. Once you do 1 or 2 really good ones, it's a fantastic fit because it's meant for them to stay in the home.
I'll tell you a really funny story. We had a 55 plus community in Florida. Mike Banner may know this community really well. We tried to get them FHA approved, and it turns out it's a nudist community. So nudist communities, we found out, are not eligible for reverse mortgages. It was a really interesting story.
Just in case you needed to know that, huh?
It was a little TMI, but it was good to know.
Good. Next question. I understand that the fees are exorbitant. Is that correct?
The fees on reverse mortgages have come way down over the years. In the past, the fees were much higher than they are today. It really depends on the value of the home and the state that you're in. A lot of the fees are state recording fees, title charges. There's an origination fee that we can charge anywhere from $0 to $6,000. We can structure that and tailor that. Oftentimes we don't charge an origination fee. I think that's a misconception that the fees are exorbitant. I wouldn't call them exorbitant. They can be high on higher dollar homes, but what we always look at is the benefit to the borrower, right? There's of course a barrier of entry. There's a barrier of entry on a forward mortgage or any type of product, right? A lot of people say long-term care insurance policies are high. Well, compared to what, right? It's all about the value, the dollars that you're paying to receive that value. But if you think they're exorbitant, I would encourage you to check out today's reverse mortgages. I think you'll be pleasantly surprised.
Can I add one note to that too?
Please.
Comparing it to selling the home, typically it's less than half the cost to sell the home. The realtor fees are like 6%. We are less than 3% typically on most reverse mortgages.
Yeah.
Great. This will mean more to you than it does to me. How do you recommend addressing the $16,447.50 mortgage insurance objection? In parentheses, it says HECM lending limit of $822,375 times 2%. I presume that means something.
Yes. So on FHA loans, there is mortgage insurance. Now, what that insurance does is it protects the borrowers and the heirs. All reverse mortgages are non-recourse loans, meaning that no debt can be passed to the heirs or the estate that can't be paid back simply by selling the home. The mortgage insurance is 2% of the appraised value of the home. If we're talking about a home in excess of $800,000, again, it's all about that benefit to borrower and what makes sense and what perhaps doesn't make sense. Yes, the mortgage insurance is costly, but when you look at the fact that you're not passing on a debt to your heirs and to your estate, how much is that peace of mind worth? Right? I would argue it's worth quite a bit. Anything to add to that, Christina?
I'd love to. Yeah. So I actually present that as a benefit because nowhere else can you find a mortgage where you don't have to make a payment the bank tells you to on a regular schedule. And that's only possible because of that mortgage insurance. Regular FHA mortgages have mortgage insurance as well. VA mortgages have a VA funding fee. And nobody gets hung up on that. But in reverse, it's this big item. Then the other thing is we have options that don't have mortgage insurance, but the rates are a little bit higher. So when you lay out those both options, $1,000 closing costs, but you're going to start with a rate in the 5 or 6s, or we can get you a rate in the 3s, but you've got this mortgage insurance. How long are you going to live in the home? And really go into that. And typically my clients don't have any issue of that once they really understand the benefit and the protections that they're buying for themselves with it.
Okay, let's see here. One question here was they thought it was 62 or is it 60? What's the age? Minimum.
Christina, you want to take that one?
Sure, different options. So 62 is the FHA HECM, and then we have portfolio or private or jumbo reverse mortgages. Those are the kind without that mortgage insurance. And we can actually lend to people age 60 and up. So a common talk has been 60 and up because then we'll help you figure out which one's the right option for you.
Okay. Are there any excluded expenses that the funds cannot be used for? Property taxes, homeowners insurance, or HOA fees?
The proceeds can be used for whatever the borrower wants to use them for. We don't put restrictions on the borrowers. Now, there's been a lot of talk over the years, what you can or should be using reverse mortgage proceeds for. There's been a lot of banter between the long-term care industry and the reverse mortgage world, right? Can they be used to fund long-term care policies? Can you use them to buy annuities? Annuities and the securitized products, we tend to stay away from. We're not discouraging it. We're not encouraging it. That's not a conversation really for us, right? The reverse mortgage is the funding mechanism for options, right? It's up to our client. Now we need to educate them, but it's up to the client to work with their financial advisor to then figure out what's the best usage of this money. So we're not saying yes or no to annuities. We're not saying yes or no to any product. It really what makes sense for the borrower. But there's no restrictions as to what the borrower can do once they have their money. It's their money. We're just making it accessible for them.
Okay, this is a longer one. What are the plus and minuses for a couple who is 62 and 58 today of applying for an HECM today versus waiting 4 years for the non-borrowing 58-year-old spouse to turn 62 and then apply?
You take that one first, Christina?
If you want it, you can have it.
Yeah, for me, it's what are home values looking like right now? Like the home values are so high right now. Who knows if they're going to stay like that? I mean, I'd say let's look at it both ways. Let's do a side-by-side comparison. Let's look at the analysis today versus when both parties are of age. Now, there are several non-borrowing spouse protections built into reverse mortgages. There was just a new protection announced, I believe, a week or two ago. So non-borrowing spouses are very protected. They will never lose the home once the older spouse passes away, so long as they maintain the home, pay the taxes, the insurance, and the upkeep of the house. There's advantages and disadvantages. It really is case by case. What we're looking at now, and what a lot of couples are making the decision to do now, is to take it right now because we're on the top of this housing bubble, and in all likelihood, who knows what this bubble is going to look like, but in all likelihood, the market isn't going to continue to rise at the rate that it is now. So locking in their equity position today with a reverse mortgage may be more beneficial. It may be beneficial to take it today, lock in this equity position, and then when both parties are of age, refinance the reverse mortgage and replace their existing reverse mortgage with a new reverse mortgage incorporating both spouses.
Okay. Does the line of credit have a guaranteed return rate and a floor?
So it's a guaranteed growth rate. So the growth rate is a 0.5% over the interest rate on the loan. The interest rates on lines of credit are adjustable. So if the rate goes up, so too does the growth rate. If the rate goes down, so too does the growth rate. But the floor, I guess you could say the floor is 0.5%. If rates go to 0, you're at 0.5%. So that would be the floor. And the max really depends on how high interest rates go. That the growth rate is attached to that interest rate.
Why does the lender need mortgage insurance for 50% loan to value?
It's a great question. The mortgage insurance isn't just for the lender. It's for the borrower. It's for the heirs of the borrower. It protects everybody. So let me address the 50% loan to value. Keep in mind, there's no monthly payment requirement, right? And so if the borrower chooses to not make a monthly mortgage payment, and a lot of our clients choose that route to defer, the balance is going to be rising as the years go on, right? And so what happened years back when we were lending 75% was the home turned upside down too quickly. And we don't want that. Nobody wants to be upside down. We want at the end of the reverse mortgage for there to be equity left. So there has to be room for that to happen. And this is a mortgage loan. We're not lending them 100%. We're lending them roughly 50%. I lost my train of thought there. What was the second part to the question?
Ooh, now I've erased it.
Christina, do you remember the second part? Oh, why the mortgage insurance? I got it. The mortgage insurance is there to protect everybody. It also protects the borrower and the borrower's estate and the heirs. And so no debt, you're not going to put your heirs in a position where they're having to cut a check for your reverse mortgage. So worst case scenario, the heirs walk away. They don't receive any home equity, but they don't owe anything. Best case scenario, they sell the house and the reverse mortgage just gets paid off and they walk away with any remaining equity.
If I could add to that too, just think of the borrower who lives to be 110 years old. That mortgage balance may really grow high. There's not a term. Mortgage isn't due because you've had it for a certain amount of time or because you are a certain age. So you do need to have that mortgage insurance to protect everyone if that situation were to happen. And hopefully in our lifetimes, we'll see that client that has a reverse that lives to 110.
Absolutely. Think of it like gap insurance for your car, right? You total your car, you owe 20, the insurance company cuts you a check for 10. There's an insurance policy that covers that gap. This insurance works in very similar fashion. You're protecting yourself in case the event happens where you owe more on the reverse mortgage than the home is worth at the time of sale.
Stephen, are you good with a couple more questions?
Yeah, bring them on.
Okay, this is an interesting one. If property is still owner occupied, but certain rooms are rented out to tenants, will it be eligible for a reverse mortgage?
Great question. We can lend on a 1 to 4 unit property. We can do a reverse mortgage on it so long as at least one of the rooms are occupied by the reverse mortgage borrower.
Okay. Another quick one here. Can we contact you for a current client who has a higher reverse mortgage from 15 years ago?
Absolutely. We are refinancing reverse mortgages at an incredible rate right now because the market warrants it. You know, rates are low, values are high, mortgage insurance premiums have come down, costs have come down. It's a great time to look into a refinance of a current reverse mortgage.
Can you discuss the non-recourse aspect of a reverse mortgage?
I'm happy to. Do you want to take that one, Christina?
I think we kind of just covered it.
Yeah.
I mean, that's really what we're talking about, the gap insurance. If the value of the home at the time the person passes is less than the value of the balance of the mortgage, well, then the insurance covers that. And that's the non-recourse feature. So I think we kind of covered it. If there's a follow-up question or some aspect of that we didn't cover, please chat it to us.
I didn't understand that word, so didn't know you did. Does it have to be a traditional long-term care, or can it be a hybrid product for long-term care?
I can take that one, Christina. I mean, that's up to the insurance producer to put the best possible product in front of the client. The reverse mortgage, again, is really just the funding mechanism for a lot of different things. You know, long-term care potentially being one of those things, but the reverse mortgage is just making that 8.05 trillion in untapped equity. We're just making some of that equity accessible. And then what they do with that, what type of policy they fund with it, that's up to them. And that's where I would say it's up to a great insurance provider to provide them with all the right potential options.
Great. I have heard others say to use a reverse mortgage to buy a second property, but you said that could not be used for that. Is that correct?
You cannot use a reverse mortgage purchase loan to purchase an investment property. Now, if you have a lot of equity in your home and you want to take out a reverse mortgage and do so in a lump sum, where we're giving you a lump sum check, and you want to take that lump sum check and go buy another house, that's your prerogative. You can't have a reverse mortgage loan on an investment property. But again, there's really no restrictions as to what the client does with the proceeds once they're in their hands.
Are we allowed to refer a client to buy a financial product like long-term care policy? Not exactly sure where that's coming from.
Sounds like it may be from a loan officer or somebody that's not a long-term care producer.
Okay.
Absolutely. I mean, why can't you refer? I would like to know more of the context, I guess, to that question, but you can absolutely make a referral. Now, you can't receive a referral fee or anything like that, or a kickback, but you can absolutely make a referral.
I think that answered another question here as well. Any state-specific regulations that disallow some of these transactions? For example, New York.
Well, we're not licensed in New York. It's the only state that we're not licensed in. New York has some really goofy guidelines and laws, and licensing is tough there. Not on our end. Now, on the long-term care side, I can't speak to that. I mean, I have the designation and know more than I think the average person about long-term care, but there's a lot of producers on here that would know more about the state-specific regulations than either Christina or I would. When it comes to the reverse mortgage, the majority of them are federally insured products. And so there's really nothing state-specific other than the municipality fees, some of the recording charges, and that sort of thing.
Okay. Well, I think I mean, there's many, many more questions. I'm going to send those to you, Stephen. We'll get answers because we know who asked the question. So that was an awesome presentation. I'm going to cut it off just because you're going to get more than you bargained for. So Stephen gave you his contact information. He was open to that. You can see his phone number in his name. It's kind of a dot. There it is, better. So perfect.
Yeah, please reach out to us anytime. We're here to help. You know, the time is now. I'll leave you with this. And Christina, you of course, leave the audience with something too. If you're going to take one thing away, go all the way back to the first slide and think about the amount of people who are buying long-term care insurance, 3%, and the amount of people that are taking out reverse mortgages, 2%. If that's not reason enough for our industries, the long-term care industry and the reverse mortgage industry, to join forces, we should be speaking at each other's conferences. We should be holding webinars like this all the time. There should be referrals passing back and forth, left and right. This is the time. We have a solution to help you, and you have a solution to help our clients. And to me, that's the perfect storm. This is all about building additional value and being able to provide that additional value to the clients that we serve, the clients that deserve the best care and deserve the best possible funding mechanisms to pay for that care. So the time is now. We're excited. We're eager to work with you. Please reach out. Make sure we're connected on LinkedIn and Facebook. And with that, I'll have Christina leave you with her parting words.
Yes, I appreciate the enthusiasm. Someone just said, if we're willing to stay on, why won't you stay on? So we are busy. We'd love to stay on with you guys, but the majority of what we're seeing in the comments that are too nitpicky to answer are actually scenarios. And it's hard to answer rough numbers because the reverse mortgage loan amounts are gotten to by current interest rates, the youngest borrower's age, and the home's value. So if you have a scenario that you actually want numbers on, please email those to us and we'll get you those numbers. We can't really rough it. And even the costs, you're asking like, what's the generic cost? I don't like to rough it because it's very specific. And as interest rates change, as home values change, that changes over time. So if you have a client who said, oh no, I don't qualify for a reverse mortgage a year ago, well, we might want to take a look today because the loan amounts are much, much different as things change. So please do email us. We'd love to stay in contact. We are here to support you guys and we can do really quick scenarios. We don't have to dive into an actual client specifics with some of these basics and give you an idea if it might work.
Well, thank you. And thank you, Stephen, for giving the plug for the IDFA, Institute of Divorce Financial Analysts. That is a sister company, a sister designation of ours. And you'll just get a little different slant on it. So what was that, June 16th?
June 16th, yeah, please join us. If you email reverse@primres, PRIMERES.com, we'll make sure we get you all the information for sign up. If you go to the IDFA/learning, I believe, I'm not sure if they have the link up yet, but you can register there or reach out to us and we'll make sure you have the registration. And if you're following us on social media, you'll see it and it'll be all, we're going to have it out there. We're loud and proud about our partnership with the IDFA and CLTC. And there's going to be a lot of these webinars coming up. The best place to find those are on our social media channels.
Well, you answered a lot of questions, and misinformation creates all kinds of issues. So it was very informational. And again, we thank both of you, Stephen and Christina. Have a great day.
Thank you. Thanks, everybody.
Thanks for having us.
Bye-bye.